You can kind of feel it in the air right now, can't you? This anxiety, a feeling that the economic ground we're standing on isn't quite as solid as we thought. You hear these words everywhere, recession, depression, and they sound frankly terrifying. But what do they actually mean? What's the real difference? And, the big question is, what can the huge economic crises of the past teach us about what might be just around the corner? Today, we're going to dive deep into exactly that, and we'll start with a surprisingly simple way to think about it.
There's this old joke that does an amazing job of getting right to the heart of this topic. A recession is when your neighbor loses his job. A depression is when you lose yours. It's kind of funny, right? But it's also powerful because it cuts through all the jargon and gets to the human side of it all. Before we dive into charts and numbers, this one little line reminds us that these aren't just abstract ideas. These are real events that turn people's lives upside down. It's the difference between hearing about a problem on the news and having that problem show up on your doorstep.
So here's our game plan for this explainer. First, we're going to get our terms straight, the real difference between a recession and a depression. Then we're going to jump in a time machine and compare two massive crashes, 1929 and 2008, and you'll see a pretty shocking similarity. After that, we'll get into the great policy divergence. This is the key reason one became a depression and the other didn't. From there, we'll look at the warning signs blinking in our economy right now. And finally, we'll explore three very different ideas about what tomorrow might actually look like.
Okay, let's start at square one. To really get into this conversation, we've all got to be speaking the same language. So, what exactly are we talking about when we throw these words around?
A recession, well, it has a kind of technical definition. The rule of thumb you'll hear most often is 2 straight quarters, so 6 months, where the GDP is shrinking. And GDP, gross domestic product, that's just the total value of all the stuff and services a country produces. So when that number is going down for half a year, it's a big red flag that the economy's hitting the brakes. It means we, as a country, are making less, which almost always means less income, less spending, and fewer jobs.
Now, a depression, that is a whole different animal. There isn't some strict rulebook definition like X number of quarters. Instead, a depression is defined by its sheer devastating scale. Just think of it as a recession that's gone completely off the rails, a total catastrophe. We're talking a long, deep, brutal downturn with massive unemployment and a near-total collapse in economic activity. Honestly, we've really only had one in modern times, the Great Depression, so it's almost more of a historical event than a normal part of the economic cycle.
Okay, so with those definitions in our back pocket, let's fire up that time machine. We're going to look at the two most infamous financial crises of the last 100 years, the 1929 stock market crash and the 2008 financial crisis. And what's absolutely wild is that when you look at the initial shock, the raw power of the punch to the global system, they were almost eerily similar. First, let's look at 1929. After that crash, the S&P 500, which is a great snapshot of the US stock market, just went into an absolute free fall. From its highest point, it eventually cratered by a staggering 83.4%. That's an almost unimaginable destruction of wealth. It wiped out entire fortunes and just shattered the country's confidence for a whole generation.
Now let's jump ahead to 2008. The crisis that started with all those bad mortgages also sent the market into a nosedive. The S&P 500 dropped 54.1% from its peak. Now, while that's not quite as deep as the 29 crash, make no mistake, this was a massive, devastating collapse that sent shockwaves through the entire planet's financial system. It was, by any standard, historic.
And this brings us to a really critical point from a couple of economists, Eichengreen and O'Rourke. They were writing this right in the middle of the mess in 2009. And after looking at everything, global trade, production, stock markets, they basically said, hey, the world is going through a depression-sized event right now. They argued that in the early stages, the 2008 crisis was just as bad, if not worse, than 1929. So that raises a huge question. If the initial hits were the same size, why was the final outcome so dramatically different? Why did one lead to a decade of misery, and the other, well, it was awful, but it wasn't that?
And that brings us to the absolute core of this whole explainer. The answer isn't in the crisis itself. It's in how we responded. The different results were a direct consequence of the lessons that policymakers either learned or failed to learn. This is the story of the great policy divergence. This slide just lays it out perfectly. It shows the two different roads that were taken. Back in the 1930s, the response was to tighten everything up, what they call monetary contraction. The Federal Reserve actually made money harder to get, and the government just stood by and let thousands of banks fail. When the banks went under, people's life savings just vanished, which sucked even more money out of the system. This kicked off a horrible debt deflation spiral. Basically, as prices for everything fell, the real value of people's debt actually went up, crushing them and making them spend even less. Now compare that to 2008. The response then was built entirely on the lessons from that first failure. We saw massive monetary expansion, bailouts, TARP, all of that. And crucially, deposit insurance, which was created because of the 1930s, meant people didn't panic and pull all their money out. The goal was to pump liquidity into the system and stop that deflationary spiral at all costs.
This quote from the Nobel-winning economist Milton Friedman just nails it. He basically argued that a stock market crash, even a big one, isn't enough on its own to cause the depression. The real trigger, the thing that turns a really bad recession into a once-in-a-century disaster, is a full-on collapse of the money system. It's the choices made by central banks and governments to either let it all burn down or to step in and prop it up that make all the difference.
So, that's the huge lesson from history. And it brings us right back to today. With that knowledge, what are the signals telling us right now? Let's take a look at the warning signs that have economists watching very, very closely.
So when we scan the horizon in 2025, a few things definitely pop out. First, we've had this stubbornly high inflation that's been eating away at everyone's budget. To fight that, central banks have been hiking interest rates like crazy, which makes it more expensive for anyone to borrow money. On top of that, we're seeing the global economy slow down, especially in big places like China, and that messes with our supply chains. There are also these little pockets of financial stress, like in commercial real estate, where empty office buildings are putting a lot of pressure on smaller banks. And finally, people are taking on more and more debt, which makes them way more vulnerable if things go south.
But let's zoom in on one specific indicator that's, well, it's kind of alarming. It's nicknamed the Buffett indicator. It's pretty simple. It just compares the total value of the U.S. stock market to the country's GDP. Warren Buffett himself said it's probably the best single measure of where valuations stand. And he warned that when that ratio gets near 200%, you are playing with fire. Well, as of October 2025, it's sitting at 219%. Now, to be fair, we have to add some caveats. The economy is different now. A lot of U.S. companies make money all over the world, and that can skew the numbers. But still, it's a pretty stark signal that by this historical yardstick, the market is in some very pricey territory.
So with all these warning signs and historical lessons in mind, the million-dollar question is, what's next? And there's definitely no single answer. Instead, you have these competing visions for what our economic future holds. We're going to walk through 3 of the main scenarios being talked about right now. Okay, scenario 1 is probably the mainstream forecast. It's the idea of a moderate recession. So in this version of the future, the economy slows down a lot, but it doesn't completely fall apart. We'd probably see unemployment tick up to somewhere between 6.5 and 7.5%, which means millions of people losing their jobs. Company profits would likely fall 15 to 25%, which would trigger a stock market correction that could vaporize something like $5 to $8 trillion in wealth. It would absolutely be painful, no question, but it would be a manageable downturn, kind of like other recessions we've seen before.
Then there's the second way of looking at all this, the long-term investor's view. This perspective basically says, yeah, recessions happen, they're part of the deal. But it frames them not as a catastrophe, but as a normal, temporary dip in a much longer journey. If you look at history, bull markets always last way longer than the bear markets that interrupt them. I mean, think about it. If you had invested right before the dot-com bubble burst in 2000 and just held on through that crash and the 2008 crisis, you'd still have more than quadrupled your money by now. So for a patient investor, a downturn isn't scary. It's an opportunity to buy great companies on sale and build real wealth over time.
And finally, there's the more contrarian take, the idea of a recession as a necessary, maybe even a good reset. The argument here is that for years, our economy has been kind of artificially propped up by huge amounts of government spending and debt, and that's really only benefited the wealthy while the middle class has been stuck. So in this view, a recession is the painful medicine we need to take. It would bring down crazy asset prices, like housing, and maybe create a generational wealth transfer so younger people could finally afford to buy in. It would clear out all the unproductive businesses and allow a healthier recovery to grow from the ashes, led by new, innovative companies. It's the short-term pain for long-term gain argument.
So, when you boil it all down, the single biggest takeaway is this. History teaches us that the crisis itself isn't what defines the outcome. What matters most are the choices we make when we're in it. In the 1930s, bad policy choices turned a crisis into a catastrophe. In 2008, the lessons learned from that failure helped us avoid doing it all over again. Today, we can see the new warning signs on the horizon. The real question, then, isn't if a crisis will come, but how we will choose to react when it does. Faced with a whole new set of challenges, what lessons from our past will we choose to remember? And which ones might we forget?